Hey everyone, welcome back to Corporate Decoder. Today, CCLD just filed an 8K announcing shareholder meeting results, and I am seeing one key plan approval that matters. Quick note, this is not financial advice, just my take on public filings for educational purposes. CareCloud shareholders have approved a new equity incentive plan, which is a pretty big deal for how employees and executives will be rewarded going forward. So, this is a current report basically telling us what happened at CareCloud Incorporated's recent annual shareholder meeting on the 4th of June 2026. The big news revolves around a plan they are calling the 2026 Equity Incentive Plan. Think of this plan like a way for the company to give out stock or options to its employees, especially key people like executives, to encourage them to perform well and stay with the company. Shareholders voted to approve this plan, which allows the company to issue up to 1,000,000 shares of their common stock. This is important because it affects how many shares are out there and can potentially dilute existing shareholders if those options are all exercised. The report breaks down how the shareholders voted on various issues. It mentions that as of the 7th of April, there were over 42 million shares eligible to vote. First up, director elections. Two people, Mahmood Haq and Cameron Munter, were up for re-election. Mahmood Haq received a strong majority of 4 votes with over 13.7 million. Cameron Munter also got a lot of 4 votes, just over 10.1 million. This means the shareholders are comfortable with the current leadership directing the company. Next, shareholders voted on the compensation for the company's top executives. This vote is advisory, meaning it is a way for shareholders to voice their opinion. Over 14.1 million votes were in favor of the executive compensation, which suggests general approval of how the company is paying its leaders. Now let's focus back on that equity incentive plan we talked about. As mentioned, shareholders approved it. The voting numbers show a clear majority in favour, with over 10.8 million votes for the plan and about 4 million votes against. This approval is a significant step, allowing the company more flexibility in rewarding its team. It is worth noting that while approved, there was still a substantial number of opposing votes, which could indicate some investor concerns about dilution or the specifics of the plan. Another important vote was on who will audit the company's books for 2026. Tanner LLP was appointed as the independent registered public accounting firm. This vote got overwhelming support with almost 25 million for votes. This is pretty standard procedure and shows confidence in the auditors. So, what is the real story here? CareCloud is essentially giving itself the tools to potentially incentivize its workforce more directly through stock ownership. With the market cap around $102 million and a PCI ratio of 18.4, the company is in a relatively stable place. The approval of this plan, especially after a period where they completed a full redemption of Series B preferred stock in May, suggests a move towards consolidating their capital structure and focusing on internal growth and talent. It's similar to how many growing tech companies use equity to attract and retain talent, especially in the competitive healthcare sector where CareCloud operates. The goal is to align employee interests with shareholder interests, hoping that if the stock price goes up, everyone benefits. However, we always need to be mindful of dilution. While 1 million shares might not sound like a lot, for a company with a market cap of around $100 million, it can have an impact. Investors will want to watch how these new shares are granted and if they are tied to performance that genuinely drives company value. The fact that over 4 million shares were voted against the plan signals that some investors are paying close attention to this. It is a balancing act for management. Reward the team to drive growth, but don't dilute existing shareholders too much. Looking ahead, the company's stock has been trading in a range between $2.05 and $4.01 over the past year. This new incentive plan, if executed well, could be a positive catalyst for future performance. But the market also knows that incentive plans can be a double-edged sword. Ultimately, the approval of the 2026 Equity Incentive Plan is a forward-looking move by CareCloud. It shows they are planning for the future and are willing to use stock-based compensation to motivate their team. The impact will depend on how effectively these incentives translate into actual growth and profitability for the company in the coming years. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. If this analysis was valuable, hitting that like button really helps. And subscribe for more deep dives. Check out our Discord in the description.